When you think of like the absolute epicenter of the global AI revolution, your mind probably jumps straight to Silicon Valley.
Right, yeah. Or maybe, those massive server farms tucked away up in the Pacific Northwest.
Exactly. Or the tech campuses in Austin. You probably do not immediately think of the plains of Kansas or the rolling hills of Missouri.
No, definitely not.
And you certainly don't look at the utilities drawer of your stock portfolio. That famously sleepy, boring filing cabinet of safe dividend payouts and think, yes, this is where the explosive multi-gigawatt tech growth is happening.
But the landscape has completely flipped. I mean, for decades, if you bought a utility stock, you were basically buying a bond proxy.
Right. You buy it, you forget about it.
Yeah, you accepted slow, plodding growth in exchange for a reliable quarterly check, right?
Yeah.
You just assume that, population growth might tick up electricity demand by maybe 0.5% a year. Exactly. But we are looking at a paradigm shift right now that is just tearing up that old playbook. I mean, utilities in specific geographic corridors are transforming. They're going from defensive hold and forget stocks into these massive, aggressive infrastructure growth engines.
And that is exactly why we are here today. Welcome to a special Talk Tickers edition of this deep dive.
Glad to be here.
Our mission today is highly focused and specifically tailored for you, the retail investor. We are unpacking the fresh second quarter 2026 earnings call transcript from Evergy Inc.
That's ticker symbol EVR.
EVRG, right. We're looking exclusively at the words, the data, and the projections laid out by Evergy CEO David Campbell and their CFO Brian Buckler.
And the parameters for this format are simple, right? We strip away all the corporate fluff.
Nobody has time for the fluff.
No. We pull the specific numbers from the transcript, so revenue, earnings per share, margins, capital guidance, and we translate the dense Wall Street and energy grid jargon into plain language.
Because there is a lot of jargon in this one.
Heavily jargoned. But we synthesize it all into actionable takeaways for you. We need to determine if the signals in this transcript are flashing bullish or bearish for someone who's, holding or considering this stock.
Because the hook here is incredibly compelling.
Mm-hmm.
I mean, Evergy is sitting squarely on top of a data center gold rush in the Midwest.
They really are.
They have gigawatts of power demand just knocking on their door.
Yeah.
But explosive growth requires staggering amounts of capital.
Right. It's not free.
Exactly. Building power plants and transmission lines to feed the AI beast costs serious money. And navigating how a company finances that growth without crushing its current shareholders, that is the central tension of this entire transcript.
It's the ultimate tightrope walk. You have to build the infrastructure to capture the growth, but you have to fund it today while the revenues are still years away.
Yeah.
And that dynamic is woven through every single page of this earnings call.
Well, I want to start by throwing the headline numbers on the table, because looking at the top line data gives us the baseline for everything else.
Always start with the headlines.
Right. So for the second quarter of 2026, Evergy reported an adjusted earnings per share, or EPS, of 88 cents.
Okay.
Looking back at the same quarter last year, Q2 2025, they posted 82 cents. So we're looking at a clean, solid 6-cent year-over-year beat.
And a 6-cent beat on an 80-cent baseline is very healthy.
Yeah, it's a solid margin.
It is. And they carried that confidence right into their full-year outlook, too. Management officially reaffirmed their 2026 EPS guidance, holding steady at a midpoint of $4.24 for the year.
Okay.
And that's sitting inside a range of $14 to $4.34.
And for the listeners who are building their own models or tracking the quarterly flow, CFO Brian Buckler offered a very specific breadcrumb for the upcoming quarter.
He did.
He guided that the third quarter should generate somewhere between 50% to 53% of that full year 424 midpoint.
Which is a crucial detail for retail investors to internalize. I mean, utilities are highly seasonal.
Right, because of the weather.
Exactly. The third quarter captures the brutal heat of July, August, and September. So it's always the monster quarter for a Midwestern energy provider.
Everyone's running their AC.
Everyone. So setting the expectation that Q3 will deliver over half the annual earnings in a single 3-month window, well, that shows a management team that has highly predictable forecasting models.
I am looking at these numbers, though, the 88 cents, the reaffirmed guidance, the steady Q3 projection. And on the surface, they look almost aggressively boring.
They do, yeah.
It looks like a utility company just ticking the boxes, hitting the marks, moving on. There are no fireworks in these headline figures.
But see, the lack of fireworks in the numbers is actually the most impressive part of this transcript.
How so?
Well, provided you understand the operational context of what actually happened to this company in June, I mean, hitting a perfectly mundane financial target is a monumental achievement when your physical operations are being ripped apart.
Oh, right. That points directly to the severe weather events Campbell discussed on the call. Early June of 2026 was essentially a meteorological nightmare for Evergy service territory.
It was devastating. I mean, they were hit by back-to-back highly destructive storm systems. The transcript details straight-line winds clocking in at 115 miles per hour.
Which is just insane for the Midwest.
Right. We are talking about hurricane-force winds sweeping across the plains. And alongside that, multiple tornadoes tore through central and southeastern Kansas, and they tracked all the way into the dense Kansas City metro area.
Let's just pause and visualize what a 115-mile-per-hour wind does to a power grid.
It's not pretty.
That isn't just a few branches falling on a residential wire. That is structural failure.
Yeah.
That is wooden utility poles snapping in half like matchsticks, heavy steel transmission towers buckling under the sheer kinetic force of the wind.
Exactly.
That's transformers being blown out and substations being flooded or just destroyed by debris. The physical damage to the infrastructure is catastrophic.
And the human impact was immediate, too. Campbell noted that 300,000 customers lost power during those events.
Wow, 300,000.
Yeah. And managing an outage of that scale is a logistical mountain. You don't just send a few trucks out.
Right.
You're activating mutual assistance networks, bringing in line crews from neighboring states, housing them, feeding them, and you're coordinating hundreds of complex, highly dangerous repair jobs simultaneously while the weather is still volatile.
To put that in perspective for you, if an earnings report is usually an assessment of how well a company sailed calm seas, this Q2 report is the equivalent of a ship's crew having to completely rebuild the engine while actively taking on water in a hurricane.
That's a great way to put it.
And they still managed to win the race. I mean, they restored power to all 300,000 customers safely over the course of a week.
Which is incredible.
And despite the massive, unexpected financial drain of paying thousands of hours of emergency overtime and replacing shattered infrastructure, they still beat last year's EPS by 6 cents and kept their forward guidance completely intact.
It really speaks volumes about the resilience of their balance sheet and, honestly, the conservative nature of their initial budgeting. Because when a utility plans its annual budget, they bake in a certain expectation for storm recovery, what they call operations and maintenance, or O&M expenses.
Okay, O&M.
Yeah, O&M. So the fact that they absorbed a black swan weather event in June without having to revise their earnings guidance downward, it means either their initial storm budget was incredibly robust, or they found massive efficiencies and demand spikes elsewhere to offset the damage.
Which brings us to the most vital question a retail investor needs to ask when looking at a quarter like this. Where did that extra 6 cents per share actually come from?
Right.
Because you don't just materialize profit out of thin air, especially when you're writing massive checks for emergency utility poles and overtime hazard pay.
No, you don't. We have to open up the hood here and look at the actual drivers behind the revenue.
Let's do it.
So in utility accounting, we look at the positive drivers, the elements pushing earnings up, and the negative offsets that drag them down. The most significant positive driver in Q2 was the margin from load growth. Simply put, they sold more electricity, and that increased volume added a full 10 cents per share to the quarter.
Okay, let's stop right there. The beat was 6 cents. The margin from selling more power was 10 cents.
Right.
So that single metric covers the entire earnings beat and then some.
It does.
I am looking at the breakdown of that 10 cents, and this is where the transcript gets genuinely wild.
Oh, yeah. This is the crazy part.
Out of that 10-cent bump, 4 cents came purely from two specific corporate facilities.
This is the core of the Evergy growth thesis right now. 4 cents of EPS growth in a single quarter generated essentially by just two physical addresses on the map.
That's unbelievable.
It is. The first is a massive new data center that was energized and started pulling power in March of 2026.
Okay.
And the second is the ongoing operational ramp-up of a gargantuan Panasonic manufacturing facility in the region.
Consider the scale of that for a moment. You have a utility company that serves millions of people across 2 states, hundreds of thousands of homes, thousands of small businesses, hospitals, schools, shopping malls, and yet almost half of their fundamental volume growth for the quarter can be traced back to a single server farm. and a single battery plant.
Just 2 places.
The concentration of demand is staggering.
It completely redefines what commercial and industrial load means for a regional utility.
Yeah, because it's not just an office building.
No, not at all. A single hyperscale data center packed with tens of thousands of next-generation AI processors running 24 hours a day requires an ocean of electricity. They don't have downtime. They don't turn the lights off at 5 p.m.
Right.
It is a constant, unyielding draw on the grid. And the Panasonic facility, which is producing advanced components, has a similarly intense, continuous industrial load profile.
So the remaining 6 cents of that 10-cent margin bump came from weather-normalized demand and favorable temperatures. Let's unpack weather-normalized, because it is a phrase utility executives use constantly, and honestly, to a lot of people, it can sound like a math trick to hide bad numbers.
It can sound like a trick, yeah, but it's actually a vital metric for understanding the true health of the business.
Okay.
I mean, utility revenues are obviously hostage to the weather. If you have an unusually brutal heat wave, people run their air conditioners nonstop and you sell a lot of electricity.
Sure.
But as an investor, you don't want to base your long-term growth thesis on the hope that every summer will be record-breakingly hot.
Right. You want to know if the underlying economy is actually growing.
Exactly. You want to know if more factories are opening, if new housing developments are being built, if the baseline consumption is rising regardless of whether the sun is shining or not.
So how do they measure that?
Utility analysts use massive historical data sets to calculate what the demand would have been if the weather had been perfectly average, what they call a standard baseline of cooling degree days.
Okay.
And when you strip out the fluctuations of the actual weather, you are left with the weather normalized demand. And Evergy's transcript reveals a 3.3% year-to-date bump in weather normalized demand.
A 3.3% structural increase in a sector where 1% is usually considered a massive victory.
It's a huge deal. And CFO Brian Buckler made a point to clarify that this 3.3% growth was not driven by residential customers simply buying more appliances.
No.
It was heavily, heavily weighted toward the commercial and industrial sectors. The local economy is industrializing and digitizing rapidly, and that baseline demand is moving up regardless of the thermostat.
Add to that the fact that early summer 2026 was actually quite warm compared to a relatively mild Q2 in 2025. So they got the benefit of the actual air conditioning load on top of the structural 3.3% growth.
Right.
And finally, the transcript notes another 10 cents per share gained from the recovery on regulated investments. Let's translate that mechanism. What does that mean?
So when a utility builds a new power plant, upgrades a transmission line, or, modernizes a substation, they have to pay for it up front. But they are a regulated monopoly. They can't just hike the price of electricity the next day to cover the cost. They have to keep track of all that spending and then go before a public utility commission, the government regulators, and file a rate case.
They basically show their receipts to the government and ask for permission to charge the customers for the new hardware.
Yes, exactly. They have to prove that the investment was prudent and necessary for the reliability of the grid.
Okay.
Once the regulators approve it, the utility is allowed to raise rates just enough to recover the cost of the investment, plus a guaranteed regulated percentage of profit, which is their return on equity.
Got it.
So that 10 cents per share represents the financial return on infrastructure they have already put into the ground, which regulators have now officially allowed them to earn money on.
So we have a massive surge in demand from data centers, strong baseline economic growth, favorable weather, and the regulated return on past investments. All of that pushes the numbers up.
Yes.
But as we noted, the final beat was only 6 cents. So the math dictates that there had to be some heavy downward pressure dragging the earnings in the other direction.
Yeah, the offsets were significant. The EPS was dragged down by 8 cents due to a combination of 3 major factors: higher O&M expenses, increased depreciation, and higher interest expenses.
Well, we already covered the O&M part. That is the physical reality of paying for the June storm cleanup, the overtime, the replacement parts, the emergency logistics.
Right.
But let's dive into depreciation and interest, because this is where the accounting reality of building a massive grid starts to bite.
Yeah, depreciation is sort of the silent, ongoing cost of being an infrastructure company.
How so?
Well, when Evergy spends $1 billion to build a new natural gas plant or upgrade a massive regional substation, that asset doesn't maintain its value forever. The day it gets turned on and starts pushing electrons, it begins to slowly wear out.
Right, the physical hardware degrades, the steel rusts, the turbines wear down, the solar panels slowly lose efficiency over decades.
Exactly. And accounting rules require the company to record that gradual loss of value as a daily expense on their income statement.
Okay.
So as Evergy expands its grid to handle these new data centers, their total asset base is getting much, much larger. A larger asset base means a larger total dollar amount of depreciation eating into their quarterly profits.
That makes sense.
It's a non-cash expense.
Yeah.
They aren't like writing a check for depreciation every quarter, but it directly lowers the reported earnings per share.
And then you have the interest expense. Because building those massive assets isn't done out of petty cash.
No, absolutely not.
Utilities are incredibly capital-intensive businesses. They borrow billions of dollars in the bond markets to finance construction.
Right. And we are operating in a macroeconomic environment where capital is no longer practically free like it was in the 2010s.
Oh, definitely not.
When Evergy issues new debt today to build a transmission line, or when they have to refinance old debt that is maturing, they are locking in higher interest rates.
Yeah.
That means a larger portion of their operating revenue is immediately diverted to pay the bondholders, which directly drags down the EPS available to the equity shareholders.
And speaking of the equity shareholders, we need to address the final offset mentioned in the transcript. Another 6 cents of decrease came from a bucket called other items.
Yeah.
Now, that bucket includes a lot of minor accounting noise, but the transcript singles out a 2-cent dilution specifically driven by convertible bonds.
Dilution is arguably the most important concept for a retail investor to grasp when evaluating a high-growth utility stock, and a convertible bond is a very specific instrument that causes it.
Let's break down the mechanics of a convertible bond for the listener, because it can sound like Wall Street alchemy.
It really can.
So, when a company needs money, they generally have two choices. They can borrow it by issuing a standard bond, taking on debt that they have to pay back with interest.
Right.
Or they can issue new shares of stock, which raises cash without adding debt, but it slices the company ownership pie into more pieces, making everyone's existing shares worth a tiny bit less.
Yeah.
That is dilution.
Exactly. And a convertible bond is essentially a hybrid of those two options.
Okay, how does it work?
So when a utility CFO issues a convertible bond, they are borrowing money from investors, just like regular debt, and usually at a slightly lower interest rate than standard debt.
Because there's a perk attached.
Right. The convertible part is that the investor holding that bond has the right, under certain conditions, to trade that debt in for actual shares of Evergy stock at a predetermined price.
Yeah, so it is a delayed fuse dilution. The CFO gets the cash today to build the power plant, and they pay a lower interest rate, which helps the short-term earnings.
Yep.
But eventually, if the stock price does well, the bondholders are going to flip that debt into equity.
Exactly.
And suddenly, millions of new shares materialize out of thin air, the pie gets cut into smaller slices, and your individual earnings per share drops.
Which is exactly what we're seeing. That 2-cent drag in Q2 is the mathematical reality of those new shares entering the ecosystem and diluting the earnings pool.
And we must keep this mechanism front and center, because as we transition into the company's future guidance, we are going to see that dilution is not just a one-time accounting quirk, it is a fundamental structural pillar of Evergy's strategy to pay for the future.
It's the only way they can afford it.
Right. But before we get to the massive future spending, we have to look at the mechanism Evergy is currently using to protect its existing customers from the sheer weight of this new commercial demand.
Yes, this is crucial.
We established that just 2 facilities drove 4 cents of EPS growth. That kind of concentrated demand is incredibly lucrative, but it's also a massive systemic risk, isn't it?
Huge risk.
I mean, if a utility builds a multi-billion-dollar power plant just to serve a data center, and that tech company goes bankrupt or decides to move in 5 years, the local residential ratepayers are suddenly stuck paying the mortgage on an empty, useless power plant.
And this is the existential fear of every public utility commission in the country right now.
I bet.
How do you embrace the economic boom of the AI data center without socializing the financial risk onto the backs of families and small businesses?
According to the transcript, Evergy's answer to this is a regulatory structure called the LLPS tariff, the Large Load Public Service Tariff.
Right.
The transcript details that Evergy currently has 2.5 gigawatts of power officially tied up across 5 signed energy supply agreements, which they refer to as ESAs under this specific tariff.
Yeah.
Add to that another 500 megawatts from non-LOPS large customers, like that Panasonic plant, and you're looking at 3 gigawatts of contracted heavy industrial load.
And to conceptualize 3 gigawatts of power, you have to look at the scale of residential consumption.
Give me a comparison.
Okay. A single gigawatt can roughly provide enough continuous power for 750,000 average American homes. So Evergy has signed binding contracts to provide 3 times that amount of power to a handful of corporate addresses. They are effectively agreeing to power the equivalent of several major metropolitan cities, all localized within a few industrial parks.
This requires a massive expansion of the physical grid, obviously. And to visualize how the LLPS tariff manages the economics of that expansion, I want to use an analogy. Let's imagine the regional energy grid as a popular, established local nightclub.
I like this. Let's see how the economics play out at the door.
Right. So you, the regular residential ratepayer, are just a local guy trying to get a drink at the bar on a Friday night. You pay your standard cover charge, you buy your drink, you enjoy the music. The system works.
Okay.
But suddenly, a group of absolute VIP hyperscalers rolls up to the door. We are talking Google, Meta, Amazon, the massive players driving the AI revolution.
And they aren't just looking for a table in the back.
Not at all. They want to rent out the entire VIP section. They require their own dedicated bartender, which in grid terms means dedicated generation capacity.
Right.
They demand specialized plumbing to handle the massive heat output of their servers. And most importantly, they are going to consume 75% of the club's entire inventory of alcohol in a single night.
A profoundly thirsty group of clients.
Exactly. Now, look at the incentives for the club owner. If the owner just lets these hyperscalers in on the standard cover charge, the club is going to be drank dry in an hour.
Yeah, everyone else goes thirsty.
Right. The owner will have to frantically rush order expensive emergency inventory at surge pricing just to keep the bar stocked. The dedicated bartenders will require massive overtime. And who is going to pay for all that chaos?
The regular guy.
The owner is going to have to drastically raise the standard cover charge for you, the regular guy just trying to get a beer, simply to subsidize the VIP's massive consumption.
Which is the exact scenario regulators are terrified of. They fear the residential ratepayers will be forced to subsidize the infrastructure required to power the tech giants.
Exactly. So the LLPS tariff is essentially the nightclub management stepping in at the door and establishing a new set of rules. The management says to the hyperscalers, look, you are more than welcome here. The local politicians want you here, and the economy needs you here. But you are going to pay a massive premium VIP cover charge before you even step foot inside.
Makes sense.
Furthermore, you are going to sign an ironclad, legally binding contract guaranteeing that you will buy a massive minimum amount of drinks every single month for the next 17 years, whether you actually drink them or not.
Wow.
And that premium cover charge is going to be used to shore up the club's finances, ensuring that the regular customer at the bar doesn't pay a dime for your dedicated bartender.
It is a brilliant mechanism, really. The LLPS tariff ensures that the massive capital requirements to build the transmission lines and substations needed for these data centers, they're ring-fenced.
Right, isolated.
Exactly. The tech companies agreed to bear the upfront capital burden and commit to long-term minimum usage bills that guarantee a return on that specialized infrastructure.
But the real question is, does this tariff actually work in practice? I mean, it sounds great in regulatory filing, but are the regular ratepayers actually seeing the benefit of this VIP cover charge?
Well, the transcript provides undeniable proof that it is working.
Okay.
And honestly, it is arguably the single most compelling data point in the entire earnings call.
What is it?
CEO David Campbell explicitly detailed their pending Missouri Metro rate case. Now, we discussed earlier how a rate case is a utility asking the government for permission to raise rates to cover costs.
Right, showing receipts.
Campbell noted that Evergy actually went to the regulators and requested a $25 million reduction in their revenue requirement for the Missouri Metro jurisdiction.
I want you to really internalize how shocking that is.
Yeah.
A publicly traded monopoly utility company walked into a government regulatory office and said, we have run the numbers, and it turns out we actually need $25 million less from our residential customers than we originally calculated.
Right.
That goes against every historical instinct of the utility sector.
It is exceptionally rare. I mean, you almost never see a utility voluntarily request a reduction in their revenue requirement during a major rate case.
Why would they?
Exactly. But they were able to do it precisely because the financial benefits generated by the LLPS tariff contracts are so robust. The premium VIP cover charge, to stick with the analogy, is throwing off so much excess cash flow that it is already visibly subsidizing the general admission.
And the trajectory that subsidy is pointing up too. Campbell noted on the call that as these data centers physically finish construction and continue to ramp up their massive power usage, that $25 million benefit to the regular ratepayers is likely going to increase over time.
It just completely validates the entire regulatory strategy. It proves to the local politicians and the public utility commissions that embracing data centers doesn't have to mean punishing the local residents.
Right.
Is engineered correctly through customized tariffs, the explosive growth of the tech sector can actually put downward pressure on local electricity bills.
That is a phenomenal proof of concept. It makes the LLPS tariff look like a golden goose. But there is a physical limit to our nightclub analogy.
Oh, for sure.
Signing up VIPs who pay premium cover charges is fantastic for the margins. But eventually, if you keep signing them up, you literally run out of floor space.
Yep.
The bartenders can only pour so fast, and the building can only hold so many people. To keep growing, you have to buy the lot next door, pour a new foundation, knock down the walls, and build a dramatically larger venue.
And in the utility world, pouring a new foundation means embarking on a massive cycle of capital expenditure.
Right.
Which brings us directly into the company's management guidance for the future. Because Evergy is preparing for a construction boom on a scale the Midwest hasn't seen in generations.
Let's start with the sheer scale of the demand they are projecting. According to the transcript, Evergy is officially forecasting a 7% to 8% retail load growth, compound annual growth rate, or CGR, stretching all the way through 2030.
We have to provide historical context for that percentage because to a retail investor used to say software companies growing at 40% a year, 7 to 8% might sound pedestrian.
Yeah, it doesn't sound like tech numbers.
No, but in the regulated utility sector, a 7% to 8% compounding annual growth rate is earth-shattering. For the last 20 years, the industry standard for load growth has hovered around 0 to 1%.
Wait, why has it been so flat for so long? I mean, the population has been growing, people buy more gadgets, everyone has a smartphone now. Why wasn't demand rising?
Because of the silent revolution of energy efficiency.
Okay.
Over the last 2 decades, as the population grew, the appliances in our homes got drastically more efficient. I mean, incandescent light bulbs were replaced by LEDs, which use a fraction of the power.
Right.
Refrigerators, HVAC systems, industrial motors, they all became highly optimized. So that efficiency offset the natural growth of the population, keeping the overall grid demand essentially flat.
So what does this new forecast mean?
Forecasting a 7% to 8% annual compounding growth means the sheer brute force demand of AI computing is violently overwhelming decades of efficiency gains.
Wow. And how exactly is Evergy getting to that massive 7 to 8% figure? Like, what is the actual pipeline?
Management breaks the pipeline down into specific tiers of certainty. So as we established, they have 3 gigawatts already signed, sealed, and locked into legally binding contracts. That is their tier 1.
The ink is dry on that.
That power is spoken for. But the expansion beyond that is staggering. They are actively tracking another 2.0 to 2.5 gigawatts of expansion purely at their existing customer sites.
Meaning the hyperscalers who are already digging dirt or already operating in Kansas are coming back to the table and saying, hey, our initial projections were wrong. The next generation of AI processors runs twice as hot. We are going to need to double the power capacity at this exact location.
Precisely. And that is just expansion of current footprints. On top of that, the CEO detailed another 1 to 2 gigawatts in advanced Tier 2 negotiations.
Tier 2?
Yeah, these are massive projects currently in the final stages of planning that would begin drawing power in the early 2030s. And Campbell expressed high confidence on the call that they will sign at least one more massive multi-hundred megawatt energy supply agreement before the end of 2026.
And if you look past the advanced talks, just looking at the broad inquiries from tech companies scouting locations, the CFO mentioned they are tracking a preliminary pipeline of well over 10 additional gigawatts of interest.
10 gigawatts of potential demand floating around a single regional utility. It's just mind-boggling.
Yeah.
It really underscores how desperate the tech sector is for reliable power connections.
So we have unprecedented, legally secured growth, and a pipeline that stretches past the horizon. What does this mean for the bottom line? Like, how does this translate to earnings per share?
From a purely financial outlook, Evergy's management is projecting that their adjusted EPS growth will exceed 8% annually starting in 2028 and running continuously through 2030.
Okay, stop right there. 8% EPS growth starting in 2028, but we're sitting here in the middle of 2026.
Yep.
There is a 2-year gap between the demand arriving and the explosive earnings growth materializing. What happens between now and 2028? Because earlier, we agreed that building a bigger venue requires capital. You have to buy the bricks before you can charge admission.
You do.
What is the actual price tag for this massive grid expansion?
The price tag is immense, and it requires a total reimagining of their balance sheet. To power this localized boom, Evergy is raising its already massive capital expenditure plan. The CFO announced they are adding $1 billion in incremental capital to their previously stated $21.5 billion plan.
So we were talking about a $22.5 billion capital deployment plan over the next 5 years.
Yes.
Let me give you some scale for that. Evergy's total market capitalization, the value of all their stock combined, is hovering roughly around $14 billion right now.
Right.
They are planning to spend significantly more than their entire current market value just on upgrading and expanding their physical infrastructure. What exactly are they buying with that $22.5 billion?
Well, the transcript directs us to their 2026 Integrated Resource Plans, or IRPs, which were recently filed in Kansas and Missouri.
What's an IRP?
An IRP is essentially a utility's long-term blueprint for how they intend to generate electricity over the next decade.
Okay.
And based on these filings, Evergy is looking at adding more than 5 gigawatts of entirely new generation capacity to the grid through 2032.
Break down the hardware for me. What kind of power plants are they building?
It is a highly diversified, pragmatic mix. They are projecting 3.9 gigawatts of new natural gas generation, nearly 800 megawatts of new utility-scale solar generation, and roughly 450 megawatts of advanced battery storage.
I'm looking at that mix, heavily weighted toward natural gas, and it tells a very specific story about the reality of powering AI.
It sure does.
We hear so much in the media about tech giants committing to 100% renewable energy, buying wind and solar credits. But you cannot run a multi-billion-dollar AI server farm, which has to operate at maximum capacity 24 hours a day, 365 days a year, on solar panels alone.
No, it is physically impossible with current technology. I mean, solar panels have a limited capacity factor. They only produce maximum power when the sun is directly overhead, and they produce zero power at night.
Right.
Wind turbines only spin when the wind blows. But a hyperscale data center requires absolute, unwavering reliability. A microsecond drop in voltage can corrupt massive data sets and damage highly sensitive processors.
They need what the industry calls baseload power, power that you can dispatch on command, day or night, rain or shine.
Exactly. And in the modern utility sector, as coal plants are being retired due to environmental regulations and age, the only viable, scalable technology to provide that massive dispatchable baseload is natural gas.
Okay.
Specifically, highly efficient combined cycle natural gas plants. The solar panels and the battery storage in the plant are vital for helping to manage the peak demand during hot summer afternoons, but the heavy lifting, the 3.9 gigawatts of raw, continuous muscle required to keep the servers humming, has to come from natural gas.
Which means laying miles of new gas pipelines, securing long-term fuel contracts, and navigating the complex environmental permitting process for fossil fuel generation.
It's a massive undertaking.
Yeah, and this unprecedented spending spree pushes their expected rate-based growth to a staggering 12%.
And rate base is the key metric here. The rate base is the total accumulated value of all the physical assets the utility owns, the power plants, the substations, the wires, upon which the regulators allow them to earn a guaranteed profit margin.
Right.
So a 12% growth in the rate base means the sheer physical footprint of Evergy's empire is expanding incredibly rapidly.
All right, I need to push back hard here on behalf of the retail listener, because I am looking at these financial mechanics and I am feeling a serious sense of whiplash.
Let's hear it.
The numbers do not align for a retail shareholder today.
Yeah.
Evergy is committing to a $22.5 billion capital plan. To fund this immediately, CFO Brian Buckler explicitly stated they're issuing $700 million to $900 million in brand new equity this year alone. They have already priced $425 million of that via forward sales.
Yes, they have.
That means they are actively printing new shares and heavily diluting the current shareholders.
That is correct. The pie is getting cut into many more slices.
And yet, as you just said, the explosive 8% EPS growth doesn't actually begin until 2028. Furthermore, in the transcript, the CFO specifically admits to a 250 basis point lag between the rate base growth and the earnings per share growth.
Yep, the financing lag.
The rate base is growing at 12%, but the EPS is lagging miles behind it. So if I am a retail investor holding EVRG in my portfolio today, it sounds to me like I am just being used as an ATM.
I can see why you'd say that.
I mean, I am suffering through share dilution to fund the massive upfront infrastructure costs for Google and Meta, and I'm being told to wait years to see any actual return on my investment. Why shouldn't a retail investor just dump the stock today and wait until 2028 to buy back in?
That is a phenomenal question, and it perfectly encapsulates the core tension of investing in any high-growth utility stock right now. The skepticism is entirely valid.
It just seems unfair to the current holder.
I get it. But to understand why institutional investors are willing to stomach this, we have to clearly explain the mechanics of that financing lag.
Explain it to me, because right now it just looks like punishment for the current shareholder.
The lag is an unavoidable reality of the regulatory timeline. As we establish, a utility company has to physically purchase the land, pour the concrete, build the multi-billion-dollar natural gas plant, and lay the transmission lines before they can charge a single customer for the electricity it generates. The capital outlay happens on day one. The revenue doesn't start flowing until day 1,000.
Right, you buy the bricks before you charge admission.
And to buy those bricks, you need massive amounts of cash. You raise that cash by issuing debt, which immediately burdens the income statement with high interest payments, and by issuing equity, which immediately dilutes the earnings per share.
But utilities use a mechanism called AFUDC allowance for funds used during construction to try and offset this on the balance sheet, right? They essentially pay themselves a paper credit while a plant is being built.
They do, yeah, but AFUDC is a non-cash accounting entry.
It's just on paper.
Exactly. It makes the balance sheet look okay, but it doesn't generate actual cash flow to pay dividends. The brutal reality is that your rate base, the total value of your assets, is growing at 12% as you pour concrete, but your earnings per share lags significantly behind because you are dealing with the immediate cash drag of interest payments and the immediate mathematical drag of millions of new shares.
I see.
That is the 250 basis point lag the CFO is talking about.
So the question stands, how is management ensuring that this massive lag doesn't just destroy shareholder value in the short term, driving the stock price into the ground before 2028 even arrives?
This brings us right back to the brilliance of the LLPS tariff and those energy supply agreements. Management is mitigating the panic over this financing lag by legally letting the hyperscalers into 16 to 17-year minimum monthly bill contracts.
The VIP cover charge.
Exactly. When Evergy goes to the bond market to borrow money, or when they go to institutional investors to sell equity, they aren't just selling a vague promise of future growth.
They have proof.
Yes, they are sliding a stack of legally binding contracts across the table, signed by some of the most creditworthy, cash-rich tech companies in the history of capitalism.
Contracts that dictate that whether the tech giant utilizes the full capacity of the power plant or not, they are legally obligated to pay a massive minimum bill every single month for almost 2 decades.
Right. It provides absolute guaranteed visibility into the future cash flows. It mathematically assures the credit rating agencies and the major shareholders that the revenues will eventually catch up to and vastly exceed the upfront construction debt.
So it's about certainty.
Yes. You are taking on the pain of dilution today, but in exchange, you are securing guaranteed, highly visible, long-term explosive growth that is immune to normal economic recessions. It de-risks the capital plan almost entirely.
Okay, that makes sense from the perspective of a Wall Street analyst looking at a spreadsheet. The cash flows are secure, but what about the local friction on the ground? Building $22.5 billion worth of infrastructure doesn't happen in a vacuum.
No, it certainly doesn't.
You are talking about eminent domain for transmission lines, disruption from construction, and changes to the local grid dynamics. Are all the local ratepayers in Kansas and Missouri just totally fine with this massive industrialization of their power grid?
That is a vital nuance that the transcript addresses directly. While CEO David Campbell was understandably eager to highlight the $25 million rate reduction in the Missouri metro area, the proof that the LLPS tariffs works, he also had to maintain transparency about the realities facing another jurisdiction, Missouri West.
What exactly is happening in Missouri West that is different from the metro area?
The grid dynamics are completely different. Campbell noted that Missouri West customers currently enjoy some of the lowest electricity rates in the entire nation.
Okay, that sounds good.
It does, But those rates are artificially low because that specific jurisdiction is historically starved for infrastructure investment.
Why is it starved?
For a complex variety of historical and regulatory reasons, they simply haven't built much new localized generation capacity there in recent decades.
So they just buy it from elsewhere.
Yeah, they have relied heavily on importing power from other areas.
Cool.
As a result, when regional demand spikes, the Missouri West jurisdiction is heavily exposed to volatile open market energy prices.
And we all know what volatile market pricing looks like. We saw it during Winter Storm Uri in Texas, where a sudden freeze constrained natural gas supplies.
Yeah.
The market price for a megawatt hour skyrocketed by thousands of %. And utilities that relied on the open market faced catastrophic financial losses that eventually got passed down to the customers.
Exactly. Relying on the open market is a massive vulnerability. To fix this, Evergy has to build new power plants in Missouri West anyway, simply to stabilize that specific grid and protect it from market shocks, regardless of whether data centers are moving in.
But because they are starting from a massive deficit of infrastructure, building anything new is going to cause a shock to the system.
Yes. The CEO admitted candidly on the call that as these new necessary generation plants come online to serve the Missouri West jurisdiction, those specific residential customers will likely see rate increases above the standard rate of inflation over the next 5 years.
So we have a tale of two cities here. In the metro area, the influx of data centers is generating enough premium revenue to actually lower residential bills. But in the West, where the grid was already underfunded, the massive capital cycle required to modernize the system is going to result in ratepayers feeling the pinch.
It highlights the localized pockets of friction inherent in modernizing a massive grid.
Yeah.
The broad systemic benefits of the data center boom are undeniable, but the utility has to manage the narrative very carefully. They have to convince local regulators and politicians in Missouri West that paying slightly higher rates now is necessary to secure the grid and avoid catastrophic market exposure later.
Which perfectly sets up our final section, where we synthesize all of these complex moving parts. We have unprecedented secured load growth. We have heavy dilutive capital costs. We have brilliant tariff structures and localized regulatory friction. It is time to distill everything into the bottom line.
Our mission right now is to take all this data and provide a clear, opinionated, and actionable conclusion for the retail investor listening today.
Let's build the argument. Start with the bull case. If I am an optimistic investor, why should I be aggressively buying Evergy based on this Q2 transcript?
The bull case for Evergy rests fundamentally on two pillars: geography and contractual structure. First, the geography. Very few regions in the entire United States are as perfectly positioned to capture the AI and data center boom as the Kansas City metro area.
What is the specific competitive advantage of Kansas and Missouri? You have cheap land and wind power in a lot of Midwestern states. Why is this region winning the contracts?
The CFO highlighted a critical bottleneck that a lot of investors overlook: EPC talent.
What's EPC?
That stands for engineering, procurement, and construction. You can have all the flat sheep land in the world, and you can have transmission lines ready to go. But if you do not have the massive specialized engineering workforce required to physically construct a multi-billion-dollar hyperscale data center and the complex high-voltage substations needed to power it, you cannot scale.
Right. You can't just hire a local residential contractor to build a facility that draws 500 megawatts. It requires highly specialized labor.
Exactly. And the Kansas City region happens to possess a deep, historic concentration of massive global EPC firms. The specialized talent pool is already living and working in the territory. It removes a massive logistical hurdle for the tech giants.
What about the political environment? Because we have seen headlines over the past year in places like Virginia or Ireland, where local governments are slapping moratoriums on new data centers because they are sucking up too much water and putting too much strain on the local grids. Are the Midwestern politicians getting nervous?
This exact risk was addressed during the Q&A portion of the earnings call. A Wall Street analyst specifically asked about the political noise surrounding data center moratoriums, particularly with upcoming state and local elections.
And what did management say?
David Campbell, the CEO, was very measured. He acknowledged that the utility must remain highly sensitive to local concerns regarding land use and infrastructure strain.
But did he sense any regulatory pushback?
No. He was clear that the political environment in both Kansas and Missouri is highly constructive. He noted that key legislative leaders on both sides of the political aisle, which is crucial for long-term stability, have historically championed aggressive economic development and infrastructure investment. The states view these data centers as generational economic anchors.
So the political runway is clear, the engineering talent is local, and the demand is insatiable.
Combine those geographic advantages with the second pillar, the 17-year contracts locked in via the LLPS tariff. You have secured the demand, neutralized the political risk, and guaranteed the return on capital.
That's a strong setup.
It is. It makes their projection of 8% post-2028 growth highly visible, highly secure, and deeply attractive for a long-term portfolio.
Okay, that is a very strong bull case, but we must flip the coin. What is the bear case? What are the specific localized risks that could derail this golden narrative and destroy shareholder value?
The bear case centers entirely on the sheer difficulty of execution and the heavy cost of capital. We spent a lot of time discussing the dilution. Issuing $700 million to $900 million in new equity in a single calendar year is a massive burden for current shareholders to absorb.
Yeah, that's real pain.
You are taking a guaranteed hit to your portfolio's value today in exchange for a promised payout tomorrow.
And a promise, no matter how legally binding the contract is only as good as the company's ability to physically execute the plan.
Precisely. We are talking about executing a $22.5 billion capital deployment plan flawlessly over the next 5 years. That is an operational high-wire act.
A lot can go wrong.
Supply chains can snag, causing delays in securing massive transformers. Persistent inflation could drive up the cost of raw materials like steel and copper well beyond their initial models. Construction timelines can slip due to labor shortages or extreme weather.
If they stumble on building these 5 gigawatts of new generation, if the natural gas plants are delayed by 2 years because of permitting issues, those timeline delays will heavily eat into their profit margins and extend the financing lag even further.
And regulatory pushback is always a lingering threat, regardless of current political support. When a monopoly utility goes to a government commission and announces they're spending $22 billion, there will be immense microscopic scrutiny on every single line item.
As there should be.
Right. If the regulators in Missouri or Kansas decide that the capital plan is too aggressive, or if they balk at the rate increases required in places like Missouri West, they have the power to slash Evergy's allowable return on equity, which directly squeezes the profit margins.
So we have the evidence laid out. The bull case offers unprecedented, legally secured long-term growth. The bear case highlights the immediate pain of heavy share dilution and the massive operational risk of executing a $22.5 billion build-out. As the expert on this deep dive, I want you to take a clear, opinionated stance based on the data in this transcript. Where do you land?
Looking objectively at the data, analyzing the contractual protections embedded in the LLPS tariff, and recognizing the sheer, undeniable scale of the 10-gigawatt demand pipeline, my stance is clear. This transcript is a fundamentally bullish signal for the long-term patient investor.
Yeah, okay, bullish for the patient.
Yes. The structural growth story here, a 7% to 8% compounding annual growth in load demand, is entirely unprecedented for a Midwestern utility. They are not merely forecasting growth based on hopeful economic models. They have the 17-year legal signatures from the most heavily capitalized companies on Earth to prove it.
It's locked in.
Right. Yes, the capital cycle is heavy right now and the dilution is painful, but management has engineered a customized tariff structure that protects the core business and guarantees the return while they build the grid of the future.
All right, let me translate that verdict directly into an actionable takeaway for you, the retail investor listening right now. If you are currently holding EVRG in your portfolio, the data in this transcript tells you to sit tight and hold your position. The short-term equity dilution you are experiencing right now is a necessary, albeit painful, bump on the runway. But the contracts are signed, the capital is secured, and the long-term flight path for earnings growth is cleared for takeoff.
I agree completely. It is a hold for current investors.
And if you are an investor considering buying into Evergy today, if you want exposure to the AI infrastructure boom without buying wildly overpriced tech stocks,
just know what you're buying.
Right. Just be acutely aware of the timeline you are buying into.
Yeah.
The heavy infrastructure spending and the equity dilution happening through 2026 and 2027 means that you are getting in on the ground floor of a massive build-out, but you are going to be waiting in the lobby for a few years.
Yep.
You will likely not see the real explosive 8% EPS growth materialize until the elevator goes up in 2028. You must have the discipline and the patience to outlast the financing lag.
That is the perfect summary. It is fundamentally a waiting game. But the prize at the end of the wait is highly visible and legally guaranteed.
Which brings us to the end of our journey through this transcript today. Let's do a quick recap of the ground we've covered. In this Talk Tickers deep dive, we unpacked Evergy's solid Q2 earnings beat of 88 cents per share and explored how they achieved it despite catastrophic storm damage.
We did.
We dove deep into the incredible data center-driven load growth that is fundamentally redefining their business model and pushing structural demand up by 3.3%. We broke down the mechanics of the $22.5 billion capital expenditure guidance needed to physically build the grid to support AI. And we weighed the heavy upfront costs of equity dilution against the incredibly bullish, legally secured long-term returns.
It is a fascinating corporate transformation to watch unfold in real time, and the execution over the next 24 months will be critical.
It really is. But before we sign off, I want to toss it back to you for one final provocative thought.
Yeah.
We have spent this entire deep dive analyzing the numbers, the contracts, and the grid dynamics exactly as they exist today. What is the one unscripted concept, the one lingering structural question that a retail investor should be pondering on their own time after they close their brokerage app?
Well, if you truly want to stress test this investment thesis, consider the massive disparity in timelines between physical engineering and software engineering.
Okay, what do you mean?
Evergy's entire golden narrative, their massive $22 billion capital plan, relies on the assumption that these hyperscalers will continue to fully utilize all 3+ gigawatts of power for the next 17 years. They are pouring millions of tons of concrete, building massive natural gas plants, and laying thousands of miles of transmission wire to feed the specific, localized AI beast.
I see where you're going with this. The hardware is permanent.
Exactly. The physical infrastructure they are building today is designed to last 40 to 50 years. But software technology and processor design evolve at breakneck speed. What happens to a Midwestern utility, and more importantly, to its captive residential ratepayers, if there is a sudden massive leap in AI chip efficiency?
Oh, wow.
What if a breakthrough in quantum computing or a fundamental shift in how neural networks are trained drastically reduces the energy appetite of these massive data centers a mere decade from now? Yes, the current LLPS contracts guarantee minimum bills for 17 years to cover the upfront costs, but what happens in year 18?
Yeah, what do you do with the power plant?
Right. What happens if the massive natural gas plants are no longer needed because the tech giants figured out how to run the same calculations on a fraction of the power? Are these utilities fundamentally building a massive 50-year cathedral of power for a technological religion that might completely change its rules before the mortar is even dry?
Wow. That is a brilliant and honestly slightly terrifying thought to leave on. Building a 50-year cathedral for a religion that might change its rules in a decade.
Something to think about.
It perfectly circles back to the very first point we made at the top of the show. The utility drawer of your stock portfolio is not a sleepy, predictable filing cabinet anymore. It is dynamic, it is volatile, it requires immense capital, and it is now tied directly to the unpredictable bleeding edge of global technology.
It absolutely is. The days of buying a utility and forgetting about it are over. You have to actively monitor the technological trends driving their load growth.
And that is exactly why we do this. Thank you for joining us on this deep dive into the transcripts. Keep looking past the headline numbers, keep digging into the underlying data, understand the mechanics of the businesses you own, and we will catch you next time.